I sat down to do a podcast yesterday. It was called Habits and Hustle. And the host asked me point blank. She said, how the heck are people supposed to be able to do what you're saying? Invest and save when right now we're living in a time where inflation is so high, people don't even have enough money to buy their eggs. How are they supposed to now live below their means and start investing and saving? And that was a very interesting question because I could see the passion in her eyes. And the reality is, yeah, it is very tough, especially in today's economy, in today's economic environment, to live below your means, to start investing or keep investing and to save some money, especially when the price of things are so high, especially when we're seeing the economy slow down. So what do? And this is where now you have to face the reality of life and make a decision based off of what's reality rather than what we want reality to be. The reality is right now, we are facing some crazy economic times around us, period. We're also seeing still high inflation, and we're also seeing the impacts of the previous high inflation. What does that mean? Life today is expensive. For the average person, your cost of living today has grown significantly faster than wages over the last few years, not to mention the last number of decades, but especially the last few years, which means for most people, if you're living the same lifestyle today as you were back in 2019, either you are going to be saving and investing less of your money, or you've had to have earned a lot more money to be able to still live that lifestyle. And so the question the host kept asking me is, what does somebody do? Because I was talking about my proposal. If you want to become wealthy, the first thing you have to do is you have to invest your money. You also have to save some money to protect you against an emergency. I talk about my 75-15-10 plan, which says that for every dollar that you earn from now on, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, 10 cents is the minimum that you save. This way, from now on, no matter what happens, when you get paid, you're always going to pay yourself first. And when I say pay yourself first, I don't mean you go into the Gucci store. I mean you're going to pay yourself to make yourself wealthy first by investing your money first. And so the question was, how does somebody do this if you were struggling with money before the pandemic and now money has become even more tight because inflation is running so high, everything is so expensive, groceries are expensive, rent is expensive, travel is expensive, insurance is expensive, healthcare is expensive, eggs are expensive. How is somebody supposed to do this? And that's where there's two responses that you have to understand. Hear me on this. You have to understand this. The first thing is, number one, understanding how to live below your means. And what I mean by this is, if the government tomorrow imposed a tax on you and they said that we're going to charge a new 25% tax on you, what would you do? You might kick, scream, complain, cry, write a letter to your senator. But at the end of the day, you're going to have to find a way to pay it. And you will. That's what happens when the government raises taxes. You will always find a way to pay it because you have no other option. If you don't pay your taxes, you're going to go to jail. And so the first thing is you have to essentially tax yourself. Now, not to fund the IRS, but to fund your wealth. So you got to tax yourself. That way you can build your own wealth. Then it's about working to earn more money. Because what I said was, if now you want to become wealthy, there's two things that you can do. We know that investing is the key to becoming wealthy. How can you invest more money? You can either spend less or you can earn more, period. And if you're in a financial situation right now where spending less isn't enough, or you're really struggling to get by in the spending less, this is where now you're going to have to work to earn more, period. There's no other option. And so that's where the host really talked to me about this and really questioned me about this, where she said, are you saying then that the average person needs to go out and get a second job? And the answer is maybe, right? If we go back in time, let's just go back to 1970s, right? We'll go back a few decades. This is before my time. I've only learned about this from the financial education that I've read online, the articles that I've read online. But in the 1970s, it was a very common thing in our society that you'd have a one income earner. And generally in the 1970s, it was the man that went to work and the woman didn't. That's just how society was then. Which meant in the 1970s, with that one income household, you had one person going to work who could then afford to buy a home, buy a car or two, pay for their kids' college, and have some money to have fun. That was the common average lifestyle in the 1970s. Were there financial struggles? Absolutely. We went through recessions, we went through pain, but generally, people had the ability to live with one income. Now, here we are today in the 2020s. We're in 2023 right now at the time of me recording this video. And now we have generally two income households, meaning you have the both partners going to work to get paid. Now, with these two income households, people are still struggling to buy a home. People are still struggling to buy a car. People are still struggling to pay for a college. People are still struggling to go on a vacation and have fun, let alone have some money to save and invest. This is the environment that we're in right now. How did we get here? Well, that's what inflation does. Inflation devalues our currency. So now the question is, if this is where we are today, where are we going to be in 20 years from now? Or 10 years from now? Are we going to revert back to the past like it was in 1970s where one income was enough to fund the lifestyle of a family? Probably not. And so now thinking, where are we in today's reality? In today's reality, we are in a time where guess what? We need more money. People need more money in order to survive, period. Now, we can be delusional to this. We can sugarcoat this. We can say it nicely and just hope that somebody else will take care of you. We can complain to the government. We can complain about the Federal Reserve Bank. We can complain about big banks. We can complain about corporations. We can complain about taxes. But this is the reality that we're in right now. This is what's happening right now. Now, if we think, where is society and money and the economy going to go? If we continue down the same track that we've been on for the last 5 decades, and it looks like inflation will continue to happen, people and households will need more money to survive, period. Now, going back to the same question, which is a very painful question, do people need 2 incomes, 2 jobs in order to survive? Maybe. If you are unable to do what I just said, if you are unable to live below your means, that way you can save some money and invest some money, you are going to have to make some changes. If you cannot live smaller, you are going to have to earn more money. Now, living smaller is also subjective. And this is where I think a lot of people will have to understand the difference between my needs and my wants. And it's okay to want nice things. It's okay to want a nice home. It's okay to want a nice car. It's okay to want to go on vacations. It's okay to want luxury things. Nothing wrong with that. I mean, that's why we're all working hard to make money, right? So you can have the lifestyle and the things that you want. There's nothing wrong with that. But you also got to be honest with yourself and real with yourself when it comes to money. Because right now, we are in this economic situation where most people are broke. And life is not getting cheaper. In fact, life is still getting more expensive. That's what inflation does. Remember, the Federal Reserve Bank has a target to bring inflation down to 2%. That doesn't mean that inflation is going to go negative. That doesn't mean that the price of things are going to go back to where they were 3 years ago. That doesn't mean that the price of things are going to drop. Bringing inflation down to 2% means that the prices of things will grow less rapidly, which means today we still have way higher than 2% inflation, which means the price of things are still growing very quickly. And the Fed's goal, our central bank's goal, isn't to make the price of things go back to where they were in 2019 or 2018. Their goal is to get the price of things to grow a little bit less quickly, which means the prices of things are still rising, which means if your income is not keeping up with inflation, your earnings are being diluted, which also means if your lifestyle is not changing, if you're keeping your lifestyle here, but your income is not growing with inflation, if your income is staying here, that means that you're using more and more of your paycheck to fund your lifestyle, which means for a lot of people now, you're having to make the tough decision. Okay, I'm struggling buying the things that I was before. I can't buy the same cars, the same vacations, the same things as before. What do I do? And this is the decision that a lot of people are making today. What do I do? Do I, A, cut back on my lifestyle, that way I can live a life that I can afford, or do I, B, go into credit card debt to fund my lifestyle? Or do I, C, dig into my savings to fund my lifestyle? Now, you don't got to be a financial genius to really understand what's going on, because if we look at the data, what we're seeing is credit card debt is breaking a new record high. And not just that, Americans are digging into their savings, not to go out and make big purchases, but to make their regular, ordinary purchases. What does this mean? Well, it goes back to everything that I was just saying. The cost of living is rising. This has been happening. This will continue to happen. No matter how much fairy dust you want to keep spraying before you go to sleep at night, this is still happening. The cost of living is rising. And if your income is not growing fast enough to keep up with the growing cost of living, you will have to either cut back on your spending, meaning a smaller lifestyle, live smaller than you were last year, or you are going to have to earn more money. Now, this is where we're running into the second predicament, which is how do you earn more money? Now, we are entering a slowing economy. We're not entering a slowing economy. We are in a slowing economy, which means businesses are making less money, which means if you're trying to get a raise, it's a little bit tougher in this economy than a year or two ago to get a raise. Why? Because businesses are struggling financially. Now, not every business, but we're starting to see this bigger trend across many different industries where businesses are seeing revenue slow, businesses are seeing costs rising, so businesses are seeing their profits shrink. So businesses are struggling to provide raises today. That's why we've been seeing bonuses get cut. We've been seeing raises get cut. We've been seeing some layoffs happen across multiple industries. We've been seeing some bankruptcies happen. So we're seeing a slowing economy, the cost of living rising, which then means, what do you do? Maybe that means you have to go out and get a second job. Maybe that means you have to go out and create your own income, but you have to do something. You cannot just sit there and complain and just watch this happen if you want to be financially free, if you want to take care of yourself, because the reality is your job. It's not my job to take care of you, okay? It is your job to take care of you, your family, and your community, period. And so this is where now you got to understand it and say, okay, I can blame the government, I can blame the Fed, I can blame banks, I can blame corporations, I can blame the whole world, but that does not change your financial situation for you and your family. If you want to take care of your wife, you want to take care of your husband, you want to take better care of your kids, you want to take better care of your parents, you got to get more money. You have to be able to invest more money. You have to be able to have money to be able to capitalize on opportunities, meaning buy investments when you see them go on sale. How do you do that? You got to have money put aside. How do you do that? You can live smaller or you can earn more. Well, living smaller is obviously more difficult today. Not impossible, but it is more difficult. Why is it more difficult? Because of all the inflation that we've been seeing happen. It's not impossible, but it is difficult. Now, I want to read you this article that we covered in Market Briefs, my free financial newsletter, that really helps kind of explain everything that I was just talking about. The title of the article is Inflation is Making Luxury Handbags Unaffordable to an Aspirational Buyer. That headline immediately caught my attention because why are luxury handbags supposed to be affordable? The whole point of luxury is that it's supposed to be unaffordable. It's supposed to be expensive. It's not supposed to be in reach for everybody. And that's why I wanted to read it and why I want to share it with you. The former chairman of LVMH said there's been a lot of inflation. And I think most of the players have taken their price to a level that's not sustainable. When you look at the appreciation of the price of an average, say, Chanel handbag, Dior handbag in just the last 5 years, it's really extended itself and it's becoming unaffordable to an aspirational buyer. Now, this really helps explain what inflation is and what causes inflation. Because one of the stories that I've talked about many times is in 2021, my wife and I lived in Chicago for a little while, and we lived close to this street called Michigan Avenue. Michigan Avenue is the shopping area, the shopping district in Chicago. By the way, Chicago is a beautiful city, one of my favorite cities. So my wife and I would take these walks down Michigan Avenue, and this is where you'd have Burberry, the Louis Vuitton, you'd have the Chanel, you'd have the Gucci, all the nice stores. And remember, this is 2021 when the free money was still flowing. Stimulus checks were still going out. Unemployment checks were still going out. Money was still going out freely to businesses and corporations. So there was a lot of free money out there in 2021. And I remember this because we would go on walks on afternoons on Wednesdays, Tuesdays, Thursdays, and they would have these 2-hour lines literally around the block to go into Gucci. And it was so strange to me because now in this 2021 period, we were still kind of coming out of a recession, right? We were in a recession, but coming out of a recession, yet luxury retailers like Louis Vuitton, like Gucci, were breaking record sales and breaking record profits, which if you think about it, something's not adding up here. We have a recession, but luxury handbags are breaking records. And so now, not only are these luxury handbag companies breaking records, but they have lines around the door where people are waiting hours to get into the store to buy a luxury handbag. So naturally, what is going to happen? The prices of these things started to go up. Why? Because, well, Gucci doesn't want every single person to wear Gucci, right? It has some level of luxury to it. And so they want to have some level of exclusivity. So naturally, they have a limited supply of items. And so now when people are lining up around the block to buy Gucci or Louis Vuitton or Chanel, now the companies are going back to their suppliers saying, we need more products. We need more XYZ. So now the suppliers need more raw materials. And now as you start to eat up more of the supply, now there's more demand for it, right? So there's more workers that have to work there. There's more people they have to train. There's more people they have to hire. And that's what then causes the prices of things to go up because now the raw material prices start to rise. When the raw material prices start to rise, the cost of making the handbag starts to rise. When the cost of making the handbag starts to rise, the cost of the final product starts to rise. When the cost of the final product starts to rise, it also costs for money to ship that product from the warehouse to the store. And now the store has a much higher cost to get the handbag, which means they also now have to charge you a higher price. And now when they charge customers a higher price, either the customer is going to say, no way, that's too much money, or they're going to pay. And what we have been seeing happen up until really recently is people kept paying the higher prices. And so because people kept paying the higher prices, the demand was still so high, which then trickled down to more and more purchasing, which caused the prices of things to go up even more. This is what inflation is. Inflation comes from the word inflate. When you inflate the monetary supply, the amount of money out there, and you give this money out, whether it's to businesses, whether it's to corporations, whether it's to banks, whether it's to people. When you give this money out, people will spend it. Now, when there's more spending that happens, that creates more demand. When you have more demand than supply, that is going to push the prices of things up. Think of it like a home. That's probably one of the most easiest examples to understand this. If you own a home, you think it's worth $400,000, you list it on the market for $400,000, and nobody makes an offer for 6 months, what are you going to do? You're going to cut the price of the home. Now maybe you list it for $375, $350, $325 until you start getting some offers. But now let's flip that same scenario. You own a home, you think it's worth $400,000, you list it for sale, and then you get 72 offers the first weekend. Now what? Well, if one offer says, I'm going to pay you $525,000 for that home, are you going to say, no, I think my home is only worth $400,000. You keep the extra $125,000 in your pocket? No, you're going to sell it for $525,000. You're going to sell it to the highest bidder. So when there's more demand, more people with money that are willing to spend, the prices of things naturally go up. That has been our economy. That has been what we have seen over the last number of years because there was so much money in the economic system. In fact, according to some of the big banks, there's still some of this excess monies in our system, which is part of the reason why the prices of things are still rising quickly. So now, this brings us to where we are today. We are seeing this economy where people have been living large. Part of the reason, unemployment checks. Part of the reason, stimulus checks. Part of the reason, businesses made so much money, so they were hiring more people. Part of the reason, people got raises. Part of the reason, people just wanted to spend more. Part of the reason is people were able to, right? There's so many reasons. There's not just one particular reason. There's so many reasons why people were able to spend more money, and people just wanted to. People felt the ability to spend. People felt especially rich the last number of years because, well, we've been seeing asset prices grow. The economy has been growing. Everything was good. Now we are starting to see things shift. And this is where now people are saying, oh man, I can't afford the same lifestyle the way that I could before. And then it goes back to the question, what do you do? Do you cut back and continue living within your means? That way you have money to invest, that way you have money to save. Or do you now dig into your credit card? That way you can continue living the life that you had before. Or do you dig into your savings? That way you can live the life that you had before. Or now do you completely make a change and you say, you know what? I am going to build my wealth regardless of what the economy is. I'm going to cut back. I'm going to continue working to earn more. Now, obviously, this is the minority mindset. So you think differently than the majority of people. But what we're seeing is the majority of people now are really starting to face this tough decision at a time where the economy is also slowing. So this is where now the question is, how do you build wealth in an economy like this? Because if you do not realize that things are not going back to the 1970s where one income is going to be enough, things are going to continue to progress. The reason why the economy has changed so much from 1970 until now is because of inflation. In 1971, President Richard Nixon took the dollar off of the gold standard, which meant the government had the ability to work with the Federal Reserve Bank to print as much money as they wanted. Prior to 1971, if the government wanted to spend trillions of dollars or billions of dollars that they didn't have, it was very difficult because our money prior to 1971 was backed by physical gold, which meant if the government or the Fed wanted to spend money they didn't have, we needed to produce more wealth. What was wealth? Gold. Gold meant wealth. So if the government wanted to spend more money, we needed more gold. In 1971, we severed that. We got off of the gold standard, which meant now money was just paper. And now we could print essentially however much money as we wanted because, well, now we have the ability to do so. Now, that's great in the short term because now when the government spends billions of dollars or trillions of dollars, it stimulates the economy. They can hire contractors, they can hire more teachers, they can build more bridges, they can do more things. So now people have jobs, people have the ability to spend, right? Because if they hire more police officers, there's more people that are getting paid. More police officers have a salary, more police officers can go and shop at their local Sweet Green, they can go to the local Chipotle, they can go to the local wherever, Lululemon, and buy whatever they want because they have an income. Right? So as people spend more, every time you spend money, somebody else is getting paid. So when there's more spending that happens from the government, more people are getting paid, more people have the ability to spend more. So now 1971, the government severs the tie between gold and the dollar, and now all of a sudden, the government has the free reign to spend as much money as they want. Because now the Fed can print money, our central bank, the Federal Reserve Bank, can print money on command. And that's exactly what happened. Inflation really started to grow. Now, what does this inflation do? The inflation devalues our dollar. Everyone says inflation is when the price of things go up. That is a byproduct of inflation. The prices of things rising is a byproduct of the value of the dollar dropping. So inflation is when the value of the dollar goes down, which causes then the prices of things to rise. What does that mean? We went from having one income households to now having two income households, to now two income households are struggling to get by, to now, what do we do? And this is where now we're facing that kind of what do we do point. And either you can understand this and work to earn more money and live below your means. That way you can build your wealth. Or you can think the system's going to go back to what it was in the 1970s. Now, I hate to be the person that breaks it to you, but we're not going backwards. We're not going back to where it was. We're going to continue to see more inflation. We're going to continue to see the economy slow down because of the higher interest rates, because of everything going on. And all these things are going to impact your ability to spend and build wealth. Now, what I'm saying is I want you to build your wealth first. Put in that sacrifice. This is a very hard thing to say because that might mean you got to downsize your house. That might mean you might have to go from a home to an apartment. That might mean you have to sell your BMW and go to a Toyota Camry, maybe even a Toyota Corolla. And it's not fun or easy because now people look at you like you lost your mind when you downsize. But I want you to build your wealth first. If you can build your wealth first, then you will have the ability to buy whatever it is that you want and not have to worry about the money. But it requires sacrifice. And that's the difficult part, is in this system, in this society especially, we live in this day and age where delayed gratification is almost like a bad word, right? A lot of things are taboo nowadays. And delayed gratification is becoming one of them. You're telling me I have to work to earn a luxury handbag? You're telling me I have to actually be able to afford it because it's getting expensive? And that's what we are coming to. And this is where now your job is to accept reality for what it is and not live in fantasy la la land and understand that system. Because now you need to make sure that you can take care of yourself, your family, and your community. Now, going back to what do you actually do? This is where now you can put even a little bit of money to work over a long enough period of time to make you wealthy, but you have to get started. Small steps will add up. If you take one step a day, eventually you're going to walk a mile. But if you just sit there thinking about what you're going to do, you're never going to make any progress. And this is where, when it comes to money and building wealth, small incremental investments made consistently over a long enough period of time can make you very wealthy. Most people don't want to believe this, but you don't need to make a lot of money to become a millionaire. If you can invest $4 a day, or even just $100 a month, that's less than $4 a day, you can become a millionaire. Numbers have showed us this from history. If you can invest $100 a month, that's less than $4 a day, and you can get an average 10% return on your money a year, and you do this for 46 years, you will retire a millionaire, which means if you start at age 21 and you start investing $100 a month and you never invest another penny besides the $100 a month, you will retire a millionaire. Now, the first question you're going to ask is, but Jaspreet, where am I going to get a consistent 10% return? Well, if we look at history, the S&P 500, which is the largest 500 companies in the stock market, have on average over the last century grown by around 10% a year. Even though we've seen recession after recession after recession, even though we've seen market crash after market crash after market crash, on average, even despite all these downturns in the economy and the market, the S&P 500 has still grown on average by 10% a year over the last 50 years, over the last 100 years. Now, you don't have to go and invest individually into each one of these companies. There are funds that will allow you to invest into something like the S&P 500. Again, the S&P 500 is a group of the 500 largest companies on the stock market. If you go to your stock brokerage, I'm not telling you what to invest in, I'm just giving you an example. Always do your own due diligence. Never trust a random guy on YouTube investing as risks. You understand all that. If you went to your stock brokerage and you bought shares of SPY or VOO, as a disclaimer, I own shares of VOO. Both of these are ETFs that give you exposure to the S&P 500. So now, if you were buying the S&P 500 $100 a month from the day you turned 21 to the day you turned 66, you would have retired a millionaire on that $100 a month. Now, of course, yeah, this is looking back in time, but that's what would have happened if you made those small incremental investments, which is why it's so important to get started, even if you don't have a ton of money to start, because most people have the ability to put aside $4 a day. Now, your next question is going to be, but Jaspreet, by the time I'm 66 years old, $1 million is going to be nothing. And sure, $1 million today is going to be worth more than $1 million in 30 years or $1 million in 20 years. You're 100% correct. But you also have to remember, I'm talking about investing $4 a day and never adjusting how much money you invest. If you start with $4 a day today, $100 a month today, and then as your income grows, you also start investing more money. Let's say you start investing $100 a month today. Next year, you invest $105 a month. The year after that, $110 a month. The year after that, $120 a month. Guess what? You're not going to have $1 million when you retire. You're going to have more than $1 million. So yeah, the value of $1 million is going to adjust with inflation as time goes on, because inflation is still here. Inflation is going to be around today and 10 years from now and 20 years from now and 30 years from now. But you can also work to match that by also increasing how much money you invest. So now the question is, well, what's holding so many people back? And this is where we have, well, a lot of things happening. Number one, it is no longer access to technology, right? I mean, we have so many tools now in our tool belt, that allow people to start investing their money very simply. That's the great part. I love that part about fintech is that investing has become so accessible for the average person, for anybody, that anybody can start investing with as little as even $1 now with some apps. The downfall now, the double-edged sword to this is people have access to this financial technology to start investing, but the financial education is lacking. And this is where now people get caught up in the wait. You're telling me that if I invest $100 a month for 46 years, I'll become wealthy. But if I put $100 into this meme stock or into this cryptocurrency or into this particular thing that's going to boom in 6 months, I could 10x my money way faster and I don't got to wait to become wealthy over the long term. Now we have the exciting and the attractive and the fun side of investing, which really isn't investing. It's trading, it's gambling, it's speculating. Look, there is a place for trading. It's not for me. I don't trade. I don't know how to trade. I've tried trading before. I spent a lot of time trying to figure that out, and I didn't make any money. In fact, I don't even know if I lost money, but I probably lost a little bit of money doing that, but I lost a whole lot of time. Over the long term, what we have seen again and 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 again are the investors, the long-term investors are the people that will make more money over the long term, period, over traders. When times are good, the economy is booming, money is flowing, interest rates are low, everything's going up, traders will make a lot of money. We've seen that happen. And then that's when people get attracted to, wow, this person made so much money on this trade. Wow, I can't believe how fast you made that much money. Wow. Do you think I should come in too? Do you think I can make the type of money too? And that's what gets a lot of people excited to start throwing their money into things that they don't understand, whether it's cryptocurrency, whether it's meme stocks, whether it's other stocks, whether it's penny stocks, whether it's anything. People will start throwing their money into things before they understand them. Because you think, what if I can also see those big returns? But the reality is, those returns are fleeting. If you get in quick enough and you sell before it busts, yeah, you can make a lot of money. But it's a game, and this is an active game, and it's a game that many people, most people will lose money in. And that's where now you have to understand the right way to do it yourself. Now you might be saying, but Jaspreet, don't you invest in cryptocurrency? Yeah, but I'm not trading. I understand a different way of investing, right? I buy cryptocurrency every day, and it's a small piece of my portfolio. It's the speculative part of my portfolio. And so for me, I don't look at buying my investments like a trade. I'm looking at things 10 years down the road and what this will be worth to me then. And I don't advocate anybody to do what I do. I want you to take your own education and invest in what's important to you. So now, if you can become a millionaire with as little as $100 a month, and you can make even more money if you invest more money, the next question is, well, what's stopping people? So it's not the technology. Now we talked about the financial education. The last thing is, well, do I really want to wait that long? And now we get into this whole investment overload, this education overload. And it's the same with so many industries, right? The good part about social media is now you have access to unlimited education for free. You can go and learn about how to lose weight. You can go and learn about nutrition. You can go and learn about money. But there are so many opinions. In the health and fitness space, there are so many opinions about what's the best diet. Is it vegan? Is it carnivore? Is it keto? Is it whatever, intermittent fasting, whatever the other diets are? There's so many options. And so if you're just getting started and you start learning about all these options, you can very quickly be overloaded with it and say, you know what? I'm just going to stick with my donuts and cream cheese and I'm going to be good with that. We see it happen all the time with money, where people start looking at all their options. Okay, I got ETFs. That looks cool. Oh, index funds. Oh, what about mutual funds? Oh, real estate. Syndicate real estate deals, crowdfunded real estate deals, private equity deals, lending money. Oh, and now all of a sudden you get bombarded with all this information. And then you have a lot of people saying, you have to invest in this one thing. This is how you build wealth. When most of the times when people are telling you have to invest in stocks, or you have to invest in real estate, or you have to invest in options, most of them have their own agenda as to why they think there's nothing else out there. In reality, you can invest in whatever it is that you want, assuming it's a good investment, right? You can invest in stocks and build wealth. You can invest in real estate and build wealth. but you have to find the right option for you. And the mistake that so many people make, and the reason why so many people don't become wealthy from their investments, isn't because they made the wrong investment. It isn't because they invested into something with the wrong expense ratio. It's because they never got started. There are 3 factors that will determine how wealthy you will become for your investments. It is number 1, time. How long do you invest your money for? Number 2, dollars. How much money are you investing? And number 3, return. What is the return that you can get on your money? You can work to improve the return, and you can work to improve the dollars. The one thing that you cannot change is time. We cannot go back in time and start investing 10 years ago, but we can get started today. That is the one factor that we cannot change. And that's why it is so important to just get started. You don't have to make a commitment, a life commitment today with your investing strategy. You can start investing in ETFs today and then 6 months later say, you know what, I'm going to invest in index funds, or I'm going to invest in mutual funds, or I'm going to invest in real estate. That's okay. You will change because you're going to learn. You're not going to know everything going into it, but you have to get started. Time is the only factor that you cannot change. You can change how many dollars you invest, because what happens to a lot of people is you start investing and you get into this whole game of, oh, wow, I'm starting to understand this. I'm starting to see that light at the end of the tunnel. I'm starting to see what it would be like to compound my money. You start playing with those compound interest calculators online, and you start to see what it would be like for your money to compound. And that's when you say, I need more money to invest because I want to put some fuel on this fire. And that's a great feeling when you get there. The first thing that a lot of people do when they get there is you stop eating out. You stop going on vacations. You stop spending money. And, that's something I think most people need to do in the beginning, that way you know how to live below your means, know how to make those sacrifices. But then the next thing is, how do you work to earn more money? And the reason why you're working to earn more money now isn't so you can drive a faster car or a bigger home like most people are doing. It's so you can invest more money. So yeah, you can change how many dollars you invest, which will impact how wealthy you become, because the more money you invest, the wealthier you can become. But then the third factor you have to also work on is the return. How can you get the highest return? Now, the way you can get the best return is, number 1, you start building that financial education. You learn how to make better investments. You learn how to, make better things, make better decisions with your money, that we can get a better return, but also pay less money in fees. That way, more of that return goes in your pocket. So you can work on the return side. You can work on how much money you invest, but you cannot change how much time you have, which is why you have to get started sooner rather than later, because the longer your money has to compound and grow, the bigger your wealth will be. And the most difficult part about this is that concept of delayed gratification, because again, in today's society, when we want something, we want it today. When we want a luxury handbag, we want it today. You buy it with 0% APR. You buy it with a no interest credit card. You buy it with buy now, pay later. It is so accessible to have whatever we want right now. And that is what got a lot of people into the tough financial places that they are today, because we want convenience. Amazon was built on the whole concept of convenience, where now I don't have to go to the store to buy something. I can buy it online. Now, don't get me wrong. I love shopping on Amazon. I barely go into the store. I don't like going into stores to shop because it's a waste of my time. I love this idea of convenience. But the whole model was built on convenience. And now it's one-click purchase. You want to buy a new laptop? You can buy it with one click. You want to buy a new microphone? Buy it with one click. Getting whatever you wanted has become so convenient. And then came, okay, you want to buy a laptop you can't afford? No worries. You don't have to afford the laptop. You can buy it, pay it later. You can pay it in installments. And this is where now the convenience is starting to impact people's finances, because now we're saying, all right, you can go and spend whatever it is that you want. Just worry about the price later. And there's a reason why buy now, pay later, 0% APR are so profitable, right? Buy now, pay later, as I like to call it, broke now, broke later, is one of the fastest growing fintech industries out there. Why? Because there's such a big demand for it. Why is there such a big demand? Well, number 1, inflation is still extremely high and the cost of living has gone up so quickly. And then number 2, people love having things now. We want to have things today, and that has caused the boom of things like buy now, pay later. But now let's think about this for a second, because the whole idea is, or the marketing pitch is, 0% APR. You don't got to pay any interest for this. And so what a lot of people think is, I found a special loophole that I can have more stuff today. It doesn't have to cost me anything because there's no interest, and I get to have all the nice things. So I found this little loophole in finance. But let's think about this for a second. There's a cost to money. There's a cost to borrowing money. Because, if borrowing money was free, banks would not charge you interest to get a mortgage. So if businesses or these buy now, pay later apps are giving you money for free with buy now, pay later or 0% APR, how are they making money? Well, they are making money. In fact, it is extremely profitable. So how? Well, the first thing is they know that if they can sell you a computer on buy now, pay later, you might also buy a mic with buy now, pay later, because you don't have the pain of paying, $3,000 for these laptops now. So now you might buy a mic to go with it. Maybe you'll also buy a camera to go with it. Maybe you'll also buy a handbag to go with it, because now you can buy all these things on buy now, pay later. And instead of paying that $3,000 up front, you can just pay $100 a month for each thing. You don't have the same pain of that money leaving you, so you're going to end up buying more stuff. So the first thing is buy now, pay later encourages people, and statistics show this, the majority of people will buy more stuff. Number two, it's, okay, so now I start buying all these things, and then I have all these monthly payments. If I don't pay it off in the 9 months or 18 months that's given to me, I'm now going to be slapped, not with a 5% interest rate, but with a 28 or a 35, maybe even a 39% interest rate. And so now all of a sudden, buy now, pay later went from this, it's a special loophole that allows me to have more stuff without paying more money, to I am paying so much extra to buy all the things that I didn't know that I didn't need, that I couldn't even afford in the first place. That's why these programs are so profitable. And this is where now you have to make that decision. What do you want first? Do you want the nice things, or do you want the wealth? And if you're watching this video, I know what it is that you want. You want that wealth first. So you have to switch the way that you think, because the reality is the majority of people will never understand this, right? We're raised in this consumerism culture, and it's very unfortunate. And if you want to break out of that, the first thing you got to do is you got to change your mindset as to what it is that you want and when you want it. Now, when you can change your mindset on the way you spend, you can change your mindset on the way that you invest, because it goes hand in hand. It is your brain strings work the same way when it comes to long-term thinking. If you want to have all the nice stuff now, what makes you think that you're going to be able to invest for the long term and build your wealth that way? If you want all the nice stuff now, you're going to want to invest your money and grow it the same way. And what ends up happening is when you want the quick returns in your money, well, you're probably going to be the one that loses your money and pays for somebody else's long-term gains. And so now you lose both ways. And then you start hating the investing game. You start hating the system. You hate Wall Street. You hate corporations. You hate banks. And you just get into this whole system of just working to pay your bills and never wondering why you can never get ahead. But it starts with your mindset now. If you want to break out of this system and really build true wealth for your stuff, for yourself and your family and your community, and build true generational wealth, it starts with your mindset. Where now, okay, when I spend my money, I'm going to spend what I can afford, meaning money that's coming out of my pocket with cash, not going into debt to buy these things. Now you understand, okay, yeah, maybe I can't buy the nice laptop today. Maybe I can't buy the nice stuff today. I got to downsize because I want to be able to afford it with cash, especially when it's liabilities, something that's not making me any money. You got to make sure you're not buying things that you cannot afford. The simplest thing you can do is follow something like my rule of 5, which says if you can't buy 5 of them, you can't afford 1 of them. Then you reframed your spending. Now you're going to start reframing the way you invest. Now you're going to understand, okay, we're working the long game here. We're working to build that wealth now. Okay, I can build wealth. I can become a millionaire with $100 a month if I have enough time. I need to just get started. And this is where now you start investing. And again, there are so many ways to invest, but you got to just get started. Start doing your research, start reading books, but also get started by putting your money aside to start investing. Then as you do that, that's when you start learning. And as you start to learn, maybe you'll change your investing strategies. Maybe you'll say, I want to invest in stocks instead. Maybe I want to invest in individual companies instead. You will start to learn, but you have to start building that discipline, because now investing is a long-term game. The people that build the most wealth are not the people that hit something quick, that hit the lottery in the stock market. It's people that are working to build long-term wealth. There's a saying, this about Warren Buffett, who says when the tide goes out, you see who's been swimming naked. And what that means is that when the free money, when the economic boom goes away, you see who's been living this fantasy lifestyle where they've been living high off of the economic boom. But then when you see that money and that whole system start to slow down, those people are the first ones to lose everything. And it can be very easy to fall into that trap because it's a very emotional thing. Oh my God, yeah, why would I want to wait to get rich when I can get rich now? I mean, get rich slowly is not a very attractive term. If you had the option to get rich quick or get rich slowly, 100 out of 100 people would pick get rich quick. But the reality is most people don't. The vast majority of people will never get rich quick. It's get rich slowly. Yet we get attracted to the get rich quick because our emotions go this way if our mindset is not wired to understand that this get rich quick is probably going to fail. We look at the opportunity, but we never look at the risk on the get rich quick. But what's interesting is when we look at the get rich slowly, now, instead of looking at the opportunity, we're looking at the risk. The risk is, man, that's a long time from now. What if it doesn't work out? What if $1 million in 40 years isn't worth as much as it is today? So instead, we take all the riskier options with a much lower potential to actually succeed. So yes, you can become wealthy, even if you don't make a ton of money, even if you don't know a lot about money, even if you don't know how to invest, as long as you get started and you can invest your money for long enough. And then as you do that, you keep learning. And as you learn, you apply what you learn. And as you make more, you also work to invest more. The more you invest, the wealthier you become. Remember, there's 3 things that will determine how wealthy you become: time, dollars, and return. As you make more, you can invest more dollars. The sooner you start, the more time you have. The return, how fast your money grows, is going to depend on how you learn, how you can minimize fees, and how you can grow the investments that you're making, right? This is all about the speed of money. How fast can you grow your money? And the way that you can grow your money faster is by learning more about money, learning more about investing, building that financial intelligence, building that financial education. That way you can go out and get better returns on your money. One question that I keep hearing, not just on YouTube, but in real life as well, is when are things going to go back to normal? When are home prices going to go back to normal? When are egg prices going to go back to normal? When are grocery prices going to go back to what they were? When are airline prices going to go back to where they were in 2019? And I have a little bit of harsh news for you here is they're not going back to where they were. We are in a new normal in our economy right now. And the reason why is because of inflation. Now, I know I've talked about inflation a million times, but you have to understand me here. The Federal Reserve Bank is the central bank in the United States, and their job is to monitor and manage inflation. Technically, they have 2 jobs. Their job is number 1, price stability, and number 2 is maximum employment. This is the Federal Reserve Bank's mandates by the government. Now, price stability, what that means is managing inflation. Because high inflation means the prices of things are rising very quickly. Negative inflation means the prices of things are falling. The Federal Reserve Bank has a set target of 2% inflation, which means the prices of things still rising, but by around 2% a year. That is the Federal Reserve Bank's target. Today, we're at significantly higher than that, which means the Federal Reserve Bank is not looking for negative inflation. They're not looking for deflation. They're looking for disinflation. There's a big difference between disinflation and deflation. Disinflation is inflation cooling down. Inflation cooling down means the prices of things are rising, just not as fast as they were before. This is what the Federal Reserve Bank is fighting for. They're fighting for the prices of things to grow slower than they have been growing. They're not fighting for the prices of things dropping. And this is where now understanding that will help you hopefully understand where our economy is going. That way you can make better decisions with your money and your time today, because things are not going to go back to where they were. Period. I mean, if we were to see a lot of economic pain, you could see a temporary period of certain prices of things falling. I mean, that's what happens when you see recessions. But generally, the prices of things are not going to fall. That is not the Federal Reserve Bank's goal. That's not the government's goal. They want to see the prices of things grow, just not as fast. Which means today, the prices of things are still growing quickly. And in many instances, they're still growing faster than people's wages. So if your income is not keeping up with the prices of things, the prices of things are going to continue to rise. Maybe they're not going to grow as fast as they were, but they're going to continue to rise, which means we're going to see a bigger gap between incomes and the prices of things, the cost of living. This is something that we have been seeing happen since the 1970s especially, but now over the last few years, it has really accelerated this bigger divide between people's incomes and the cost of living. Now, what does that do? Well, this is the byproduct of inflation. Inflation disproportionately hurts the poor and the middle class, and it disproportionately benefits the wealthy. The first thing you have to understand is that this is the new reality in our economy, period. And if you don't believe me, go to the Federal Reserve Bank's website, go study what they're saying, go study their inflation targets, and then come back to me. Because they have made it very clear that their inflation target is 2%, that they're not looking for deflation. They just want disinflation. Secondly, once you understand that, now it's time to get real with, okay, what does this mean for you? Now, going back to things that I've talked about multiple times, this means now that you are going to either have to A, live a smaller lifestyle, that way you can continue to have more money to invest and save, or B, you are going to have to work to earn more money. Now, how do you live smaller? Well, that means you're going to have to make more sacrifices, right? There's really no other way to have more money to invest besides spending less and earning more money, period. But how do you earn more money now? Because there are a lot of options. In fact, today there are more options than ever about how you can work to earn more money. Now, the most obvious would be try to see if you can get it from a job. You can try to get a raise, you can try to get a promotion, try to get a bonus. Now, there are a lot more difficulties with that option today because our economy is slowing and businesses are much more hesitant to give raises and bonuses because of the slowing economy. But that is one option. The second option is you can work to get a second job. Maybe you work to get a part-time job. And yeah, that sucks, because that means more time is going to be going to working to earn more money. But this, again, is the economy that we're in right now. If it's not working to get a second job, then the next option is, can you work to get a certificate? Can you work to change careers? Can you work to do something else? Maybe you work at a different company. That way you can earn more money. If you're not happy with the job that you're at or the career that you're at, it's not too late. This is one of the toughest conversations that I have with people, especially in their 30s. Because when people enter their 30s, you feel like you just started to build this career. You've started to really solidify your job in this industry. You've solidified your name in this industry. But if you're not happy with it, it's okay to make a change. You're still young. You have a lot of time ahead of you. There's no point to spend the rest of your life or the rest of your working career doing something that you hate when you could spend a couple of years getting back started and actually do something that gives you more fulfillment. And 5 years from now, you're going to look back and be very happy at the change that you made. It's never easy to make a change, but looking back, you are going to be thanking yourself. The one decision the thing that always helps me in those types of situations is I think of myself when I'm 65, when I'm 75, when I'm 85, and I'm looking back at my life. Will I regret the decision that I made? Or will I be proud that I took a risk, maybe failed, or maybe succeeded? And this is where I want you to think forward. Now, what is the future you going to look back and say, it's okay to make a change. It's okay to take a risk. It's okay to start over. You have a lot of time ahead of you. So now, how do you earn more money? Well, if it's a career change, that's another option. The next option is doing something a little bit more entrepreneurial. And this is why I say it is more accessible than ever for people to be able to earn more money, because earning money, thanks to the internet, has become so much more accessible. Now, you can hate this. I know there's a lot of hate on this whole idea of making money online and doing this stuff, but it's reality. There are so many ways to earn money online. You can become a content creator. I started the Minority Mindset YouTube channel with less than $500. I don't even think I spent $200 because I was recording videos in front of a white wall with my iPhone. No fancy editing equipment. I don't have any editing equipment. No audio equipment. I think I spent $25 on one light and $25 on a tripod to hold my phone up, and that was it. I just started recording videos and publishing them on YouTube. It doesn't cost anything to publish on YouTube. It doesn't cost really anything to start publishing on podcast, minus maybe some hosting fees that you might have to pay. There's a lot of ways that you can make money through content. There are ways that you can make money online being a freelancer. You can work for other companies. You can be a contractor for other companies. You can do their graphic design. You can do their video editing. You can do their accounting. You can do their bookkeeping. You can do their writing. There's a lot of different things that you can do for companies. If you have a skill, you can monetize that skill, do it on the side as a freelancer. You can go out and try to start your own side business. You can start a landscaping business, an auto detailing business, a painting business, a whatever service type of business. There's a lot of different skills that you can monetize now, not on the internet, but outside the internet that you can also provide to people. So there are ways for you to earn more money. Or if you have a business idea, you can work to now build that business idea as well. Earning money has become so much more accessible because the whole idea of earning money is you have a product and you present it to people. And back in the day, back before 2010, 2005, before the internet really popped off, if you wanted to get in front of people, you needed an office. You needed a retail store, which was expensive. And the whole game was you get a good retail store, you get a good location, you get a good corner where there's a lot of foot traffic or a lot of car traffic. And because people would then see your office sign or your business sign, you would get more business. Now, it's all on the internet. How do you get eyeballs to see you? There are billions of eyeballs on the internet today. How do you get some of these eyeballs to see you? Now, there's a lot of ways to make money now. You can get paid just from people seeing your content, advertising, affiliate dollars. You can get money by selling your own business, your own products. You can get money by promoting somebody else's business as a sponsor or as an affiliate. There are unlimited ways to make money, but you have to just understand now that that option is there and then go out and seize it. Because the reality is the prices of things today are not going to go back to where they were 4 years ago. And so if you are struggling with your financial situation today, or if you don't like the idea of cutting back, or if you feel like you cannot live the lifestyle that you want based off of the income that you have, you got to get real with the situation. Blaming the situation is not going to do any good, but getting real with the situation will allow you to find a solution, because the reality is this inflation thing is not going away. Inflation is still going to be around. It's going to take time for the inflation to come back down to 2%. How long? I don't know. But it's going to take time, which means inflation is going to be growing. The prices of things are going to be growing faster than 2% until we get there. So this is where you want to be proactive, especially in a time where the economy is slowing, where incomes are not growing fast enough. Because when you have a slowing economy, that means incomes are falling because people lose their jobs, people get their bonuses cut, people get their pay raises cut. And this is where now you have to be honest with yourself. That way you can take care of yourself, your family, and your community. And this is where you have to, number one, stay on top of what's happening in the financial world. That way you can take care of yourself. But then number two, you also got to make sure that you have the ability to then capitalize on opportunities. Now, this is why I created Market Briefs, to stay up to date on what's happening. Market Briefs is my free financial newsletter. It's an easy way for you to stay up to date on what's happening in the top finance and business news. It's an easy to read email. You can read it in less than 5 minutes every morning, and it's a simple breakdown of what's happening in the financial markets. If you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, or you can click the link down in the description below. And then the second part is, well, doing something. Having the money to be able to capitalize on opportunities, because the reality is anytime we go through economic craziness, it also creates opportunities. But the only people that can seize these opportunities are people that are prepared and financially educated. Prepared means you have money put aside to capitalize on the opportunity, and financially educated means you can actually see the opportunity when it happens. And that's where you have to be the one that is ready to do so. When the 2008 crash happened, I was very naive. That was when I was first getting involved into financial education, but that was when I first started investing in real estate. I didn't have a ton of money. I had some money put aside, but I knew people with way more money than I did, way more money than I did, who weren't buying real estate for pennies on the dollar because they didn't see the same opportunity as me. Now, I didn't really know what I was doing. I'm not going to sit here and say, oh, I knew that real estate prices were going to grow and it's going to be a great investment. To me, I just saw the numbers and I said, okay, if I can buy a property for cheap and rent it out, I can make a decent return. But everybody, or people that were more aware, educated, we'll call it educated, they were scared because they kept hearing on the news about how bad real estate was and how much people lost from real estate. And this is where now that financial education is really being able to see the opportunity against the grain, against the media, against the emotion. But you also have to be prepared with the money to be able to capitalize on the opportunity. They go hand in hand. The work from home movement that boomed during the pandemic is really starting to come to an end now, as companies are not just asking but demanding their employees come back into the office right now. Now, of course, some companies have seen some backlash from demanding their employees to come back. Like when Amazon demanded their employees to come back, some employees held strikes at their office, some employees walked out of the office, but Amazon really didn't care. They said, okay, if you don't want to come back into the office, just never come back. You can leave. You can leave the company permanently. Same with Google. When Google demanded their employees to come back, there was some backlash over there, but Google said the same thing. We are committed to bringing people back into the office because we need people to be more productive. We found that collaboration is much better in the office, so we need people to come back. Now, naturally, there are some people that are very upset about this. People meaning people who now have to go back into the office. Some people are upset because now I can't take care of my kids like I could before. I can't spend with my time with my family like I could before. I got to spend more time in traffic. And some people are upset because, well, they're working virtually as it is. They do all their work on a computer. They do all their calls on Zoom. They just have to do it in the office. But there is benefit to being in the office, because now when you're in the office, if somebody has a question, they can come directly to your desk instead of having to just Slack you. And this is where now companies are having to make adjustments based off of what's happening in the economy. Because what we're seeing right now is obviously inflation is around. It's making people's spending ability drop, right? Because when the price of your rent and your groceries are so much higher, you have less disposable income to spend on other things. And when people have less disposable income, they have to be more cautious and careful with where they spend their money because they have less money to spend, which means certain businesses are seeing less dollars coming through their doors because less people have the ability to spend. So now businesses have to get very productive because now they are looking at their operating costs. They're looking at the revenues and they're saying our revenues are not growing like they thought. Our operating costs are growing. And now we need to make our operating costs more effective, meaning either we need more work out of each employee, we need better work out of each employee, or we need less employees. And this is where now many businesses across the board, it started off with just tech, and it was kind of funny when we started seeing layoffs in tech. This started in 2022. When the tech layoffs started happening, everybody, not here of course, but most of the traditional media kept saying that this is isolated to tech industries, that no other industry is going to struggle, that it's only tech businesses that are struggling. Today, we're starting to realize it's not just tech. Obviously, tech is one of the hardest hit, but it's not just the tech industry. But now what we're seeing is businesses across the board are saying we have to make these adjustments, and they're asking employees to come back into the office because now each company is needing more productivity out of their employees because what they're finding is the productivity when people work from home is generally less. Is that 100% of the time? No. There are some people that are more productive working from home, but the majority of people statistically are less productive when they work from home. So now companies who are looking at their financials are saying, we have to turn things around. Otherwise, we're going to be out of business in 18 months or 24 months or 36 months or whatever it might be. And so now they're saying we got to get people to be more productive. We need more work out of each employee. And that's where now employees are saying, either, okay, I get that. I'm doing whatever it takes to grow the company. I'm going to come back to work. Or they're saying, I don't want to do that. And it's a real shift in dynamic because now what's happening is the economy is slowing down, which means the job opportunities out there are also starting to shrink. And so companies are saying, okay, if you don't want to come back into the office, just never come back. It's okay. They're looking to reduce their staff size anyway. So if you want to leave voluntarily, it makes the job even easier for the company. So if you don't want to go back into the office, find a different company that will hire you. Companies are embracing that now because they need less operating costs and they need more productivity out of each person because now when you enter a time where the economy is slowing, that means revenues are falling. Companies have to get more productive. They have to get more profit out of the business because when times are good, money is growing, growth is there, you can do whatever you want. the reasonableness as to what an employee can do is really whatever, because the company is making money. But when you start to see that shift, well, that's when the companies demand more. And over the last number of years, the power was really held in the hands of the employee. We did a full deep dive on this in Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so, because it's an easy and free way for you to stay up to date on what's happening, when it's happening, that way you don't get blindsided by the economy. And if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, or you can click the link down in the description below. But this is where now the shift is happening, where 2020, 2021, and even into 2022, the power was in the hands of the employee. Employees were pretty much in full control. Now we're starting to see that dynamic shift. It has not completely shifted yet. We're still seeing a lot of power in the hands of employees today, period. That is 100% true, because there's still today way more job openings than there are employees, period. And I'll talk about why in just a second. So employees still have a lot of power, but we're starting to see more and more of that dynamic shift. And if the economy continues to go in this downward direction, if we continue to see high inflation, you're going to see this shift happen even more aggressively, where the power will shift then to the hands of the employer. And the reason now why we're seeing this shift is just naturally because of, well, the whole changing tides in the economy. The Federal Reserve Bank is working now to bring down inflation by raising interest rates. These higher interest rates mean that it's more expensive to borrow money. And if you're a business, your debt costs have risen, because businesses don't have 30-year fixed rate mortgages. They have adjustable rate mortgages. And so now when you have a lot of debt on your balance sheet, you have a lot of debt on your books as a business, this debt is going to readjust at a higher interest rate, which means your costs go up, in addition to the inflation making your costs go up. So now as a business, you have higher costs, and revenues are not growing because the economy is slowing. And so now you're having to make these decisions. And the reason why businesses are really struggling is because of how fast businesses boomed in the last number of years. See, in 2020, 2021, and even in 2022, there was a ton of free money. And we saw this in stimulus checks and unemployment checks, but it wasn't just for people. Businesses were also getting tons of free handouts from the government. They were getting free loans. They were getting free grants. There's a lot of free money going to businesses. And so now when you're a business and you get all this free money, what are you going to do? You're going to want to expand. You're going to want to grow. You're going to open new industries. You're going to open new operations. You're going to hire more people. You're going to open more stores. You're going to open more manufacturing plants. And this created a huge boom, which also resulted in way more job openings because businesses had the ability to hire. But now that is changing. We haven't seen the full effect of the higher interest rates yet, but we're starting to see this change, where now that free money is going away and businesses are now having to make profit of all the growth that they had. And a lot of businesses are now saying, we don't have the capacity to manage all this growth, all this hiring that we did in the last few years. So now we need to downsize. And that is starting to shift the tides. Now, this is where a lot of people have opinions as to how much the tides will shift. Some people are saying it's just going to be a mild pullback. Some people think it's going to be a lot more severe. Some people say there's going to be no pullback. But this is what's happening right now. The higher interest rates are shifting the tides in the economy. There's no more free money like there was before. The grants are starting to go away. Debt costs are starting to rise. We're going to see more and more debt costs rise over the next 12 to 24 months. But that's where now we're going to see a real shift. And along with that is going to be the shift in the power of the workplace. In the last 3 years, it's been in the hands of the employee. Now we're starting to see that start to shift. It hasn't completely happened yet, but we're going to see more and more of that shift as the economy continues to hurt. If the economy continues to hurt, if we continue to see this slowdown in the economy, there's going to be a bigger shift. And that's going to cause a lot of changes in the workforce. And if people don't want to go back into the office and they're not willing to work, well, you can do that when you have other job opportunities. If you have another place where you can work from home, great. If you have another job opportunity, or if you have savings or you have investments that you can fall back on, great. You have the money and the wealth to do that. You have that power to do that. But when that other opportunity goes away, or when you don't have the money to fall back on, that's when you'll start to really see that shift. So what does this mean now? Well, if you're an employer, you better get serious with your business and your operations and make sure you're running lean, make sure you don't have a bunch of operational costs, and make sure your productivity is still high. Period. You don't have any other option. If you're an employee, understand the shifting tide. This is going to be happening over the next 12 to 36 months. You're going to see a lot of shifts in this. And you can hate it. You can hate me for telling you this. Look, I'm not here to make friends. I'm just here to help you be better with your money. I'm just telling you what's going on. But in the next 12 to 36 months, we're going to see more and more shifts with this happen. So if you are an employee, understand that this shift is happening on the employer side. And if you need the job that you're in right now, the common trend right now is if somebody doesn't want to come back into the office, you're going to be the first one to go. Period. And so understanding that and figuring out what type of lifestyle you want, what type of job you want, and what type of career you want, and if the job that you're at right now is going to provide that. So just be honest with what's happening, understand it, and then make a decision based off of that, and understand that, the work from home culture is changing. And if you want the ability to be hybrid, you're going to have to now prove it even more. And you might say, but Jaspreet, I'm already working hard. I'm doing this, I'm doing that, and I don't want to work hard. Look, if you want your company to let you work from home a couple of days a week, you're going to have to prove it, because in the business's perspective, productivity is going to become essential for each employee. And if you cannot show that, they're not going to be able to approve it. This is the situation that we're in right now, and that's why I want you to understand this. That way you can be proactive and take the best care of yourself. That way you have the ability to take care of yourself, your family, and your community, right? Because if your company's struggling, they're going to make certain decisions. And you want to know what factors and criteria they're going to be looking at when they make these decisions prior to that decision being made. That way you can make sure that you are protecting yourself. Now, does this guarantee you're going to protect yourself? No. But these are the factors that companies are looking at. An employees' productivity and ability to come into the office are now crucial. Google talked about this. The CEO of Google said that in the coming productivity meetings with employees, one of the things they're going to look at is how many times the employee signed into the office with their badge. These are going to be things that are discussed in their quarterly or monthly meetings with their superiors. So yes, tides are changing. It's not just tech. It's going to be happening in other industries. So understand this. Know what's going on with your company. Obviously, every company is different. Every person is different. But understand what's going on. That way you don't get blindsided by what's happening, and you can be proactive and take the best care of yourself, your family, and your community. Everybody wants to be a millionaire, but that's one of the worst financial goals that you can set for yourself. Not because it's bad to be a millionaire, but because most people have a misconstrued conception of what being a millionaire is. I'll show you. Let's assume that you went out and you bought a home for, say, $200,000, and then a few years go by and now your home